We are celebrating it by inviting a very important person in the mutual fund industry itself, the CIO of SBI Mutual Fund, Navneet Munot. Navneet, good morning and thank you very much for dropping in. I think you all can celebrate mutual fund days practically every day of the month. Can you give us some idea of the trend of funds? How good was it in the just concluded month, May?
Yeah, it's been a good month. Again, another good month. And as you know that most of the money is coming through the SIP, and that's the interesting part, that investors are becoming more mature. They are taking a lot more long-term view. They are not coming in market to make a quick buck in the next few months or few quarters, but taking a structural long-term view on Indian equity. So that's the best part of the flows.
What's the debt equity split, and has it now become a little more towards equity?
I think the bulk of the retail flows have been into the equities. Bond yields, I mean, of course, saw some volatility in between, and after that there was a bit of slowdown. But I expect that if you have a guidance of maybe a more stable rates going forward, I'm sure at some point in time flows into the bond funds are also likely to increase. The larger part is that a good part of household savings are moving towards the financial assets. And I think both the long-term bonds and equities are going to see the benefit. You have seen some of these InvITs, etc., some of the other asset classes. You will have REITs next year. The whole financialization of savings is a bigger theme, bigger trend.
Okay, Navneet, good morning. You know, we've been talking about some really huge numbers in terms of domestic inflows, $40–50 billion. Does it make this market immune to the kind of corrections that we had in the last bull market? You know, in last bull market, we had some severe corrections, 20–30%. This time, we haven't seen any big correction, 3%, 4% at best.
So two things. I think this is a larger trend globally also. In fact, globally also, if you see whether there is a terrorist attack in UK or Mr. Trump moves out of the Paris Accord on climate or anything that happens, you don't see those severe corrections. So maybe it's a new normal. You don't know. We are entering into a world where there's a slow but steady growth. There is a lot of flows coming in, the accommodative monetary policy. But from India's perspective, historically, we have always danced to the tune of global risk on, risk off, global risk appetite. But now with increasing flows from the domestic investors, I'm sure volatility relative to history is going to be less. No second thought about that.
Okay. Navneet, hi, good morning. You know, if you go and look at the returns that most of the funds have given, the best performing funds in the last 3 years have been the small and mid-cap funds. Your own fund has given a stellar return of 35%. Do you think that the time is still the same, that, you know, to invest into smaller and mid-cap funds rather than the large caps?
So in the last 3 years, I would have mentioned a few times that we are in a world where, given all the disruptions, given the way business is changing, some of the other support that you get from the technology, the changes in the logistics, changing consumer behavior, so on and so forth. A size and stability used to be at premium. I think a nimbleness and agility had commanded a good premium in last few years. Having said that, I think if you look at the valuation differential, because so much of money has flown into the mid and small cap space, there are pockets where some froth got created. That's why we saw some volatility that he talked about in last few days, though not at an aggregate level, but I think there were some pockets of market where we saw volatility in mid and small cap. I think when I look at the Nifty or Sensex and I look at the 10–15 stocks in terms of their weights in the index, I don't see the fraud there relative to, let's say, a mid and small cap, where some can argue about the valuation. So on a relative basis, margin of safety surely is higher in large cap space today.
Okay. But you know, in your own monthly note, you have said that actually earnings disappointed marginally and has led to earnings downgrade for FY18 by about 2 percentage points or thereabouts. In spite of it, we have seen the Nifty and, for that matter, Wall Street indices, the Nifty in particular, notching up higher levels for 20 days this year. Now, isn't that a variance? Isn't that something that should trouble you?
So variety of things, of course. I mean, if aggregate level, if you look at the earnings in the absolute number, barring few PSU banks, metals and some oil and gas, I think at aggregate level also, if you remove them, then the earnings growth is not as exciting as as it should be. Having said that, in next couple of quarters, as the revenues improve over a period of time, as the cyclical recovery is underway, and in this cycle, one of my strong call is that costs are unlikely to remain under control. Historically, we always had a period where India had a brief period of like economic recovery, and immediately all the costs, whether wages, interest costs, real estate, communication, transportation, everything goes up. And then the RBI has to increase interest rates and the whole cycle gets burst. This time it could be slightly different for a variety of reasons, including the government policy and the focus on rates, etc. I think you can have a long period where revenue growth is there, costs are under control, operating leverage kicks in, and I think you have a longer cycle of profit growth. That's what the market is pricing in. Other part is maybe on the valuation, the cost of equity and equity risk premium that we can discuss.
Okay. Navneet, what about your top bets? Any contra bet that you're taking right now in this market?
You don't have to, because I mean, if you just play what is kind of obvious or what is kind of visible, so there are, so if you can segregate the market in two pockets. On one side, you have stocks where earnings momentum is very strong. Of course, there the valuations are high, but that earnings momentum gives you the comfort. On another side, you have large number of sectors and stocks where valuations are low because the earnings momentum is not strong, or the immediate visibility on earnings is not there. So for both investors, if you are a growth investor, you can take comfort in those kind of names where earnings momentum is there. If you are a value investor, market is giving you several other opportunities if you take a slightly longer term view.
So in your SBI blue chip fund, you still have a larger presence in some of the IT stocks, Infosys, HCL Tech, etc. Do you think the time has come?
So you are seeing in absolute numbers, not relative to the weight in the index. So it would be underweight relative to the index. Again, as I mentioned, that you would have few names where the valuations give you higher comfort, and there are places where earnings momentum is strong, and I think our portfolios would be a combination of both.
So what do you do with IT? I mean, since valuations are giving a bit of comfort, do you raise your holdings there?
So maybe given the cash flows there, and I think they are going through definitely a serious, I would say, challenge in terms of how the business have been in the last 25 years. My view is that in the next 25 years, the global IT spending is going to be much larger. Unfortunately, Indian companies didn't invest as much. So all the new trends that we are seeing globally, automation, digitalization, Internet of Things, robotics, artificial intelligence, machine learning, so on and so forth, they have not invested. I think some of these companies would be able to do that. I think even in India, while nobody talks about it, even the management that I meet, none of them talk about it. I think in 5 years, Indian IT market is going to be quite big. So there would be opportunities in that segment also. Keep in mind, the 4 largest technology companies in US are bigger than India's GDP. The market cap is bigger than India's market cap. Unfortunately, the Indian corporate sector hasn't invested enough, but I think the digital revolution which is underway in India, the way we are becoming from a data poor to a data rich society, there are going to be huge opportunities in India also.
Okay, well, that larger story is taken, but Navneet, immediately, I mean, a sector like real estate, for instance, has seen a lot of hope. Is that something that you would buy? And for that matter, even drugs, pharma stocks were shunned. Are these areas where you would now look for growth?
So when you said contra, maybe that could be one of the contra on the pharma side. I think the structural story of an aging population, the world needs, I mean, the governments everywhere needs to cut down on the healthcare spending. But at the same time, I mean, when we talk about healthcare or pharma, we think that every company is similar. It's quite heterogeneous. You have companies into biosimilars, somebody is branded generic, somebody in generic, somebody catering to the Indian market. There are people who cater to the emerging markets. There are a variety of companies there, and I'm sure India has certain strength. In next several years, several of these companies, whatever challenges they've gone through in last 2 or 3 years, I think they will get over that, and there is still a huge long-term structural opportunity within that sector. Valuations have become relatively more reasonable now.
Okay, finally, I know you're not a big fan of overall aggregate market valuations, but
so I have a view there that I think if you have to look at the cost of equity also and the equity risk premium, I think if India is able to establish its credential on keeping a good macroeconomic environment for next several years, if RBI is committed towards a 4% CPI, then maybe there is a case for a lower cost of equity and a lower equity risk premium with a lot of domestic savings flowing in. Maybe the volatility is going to be less. From that perspective, valuations are not excessively high. Also, to keep in mind that we are at the trough in terms of the corporate earnings.
So are you saying we could see pickup in earnings and also valuation re-rating for this market?
Not so much of valuation re-rating. Even if they sustain, and if you have an earnings growth of, let's say, 15% plus, that's like a far better return than what you can get in any other asset class.
From what you're saying about macros, you wouldn't be terribly disappointed if the RBI kept its tone.
So I think if you look at the, events or the incremental data points in last few weeks, I mean, the oil prices are down, currency is appreciated, monsoon is well on time, the overall agri production seems to be heading towards another bumper year. Global, I mean, oil and other commodity prices are well behaved, GST is not inflationary. Considering all that, I think RBI's, they may not change their stance, but they'll be less hawkish this time.
Okay, well,